for anybody that's investing in residential, find a mixed use building. And the way you underwrite those is the apartments should pay for all of the expenses. Whatever retail you have on the first floor should be pure profit.
All right, ladies and gentlemen, welcome back to the Passive Cash Flow Podcast. I'm your host, Aaron Fragnito, and we have an interesting guest today, the famous, the successful Ash Patel. How are we doing today, Ash?
Aaron, great and great to be here, man. Thank you.
Absolutely. So I enjoyed connecting with you at the Best Ever Conference just about a month ago or so, where I was presenting in the Pitch Slam, which regrettably I did not win, but I got some great feedback from you and the other judges there. And, we started talking about your investment strategy beyond multifamily. And since then, as I've gotten to learn more about your business model, man, you've planted a seed in my head about going beyond multifamily. So I want to have you on the show here to learn about how people can expand beyond multifamily to build their wealth. How's that sound?
It sounds phenomenal. Let's get to it.
Absolutely. So before we get started here, why don't you just give us a little background, kind of how you got started in this space, and start with your company as well there.
Yeah, Aaron, I was an IT guy for 15 years, right? I was on that corporate ladder, never enjoyed it, knew it wasn't going to be what I wanted long term. It paid the bills for a lot of years. I always had a side hustle. I had everything from a web design business, a sports supplement company, an SEO company, and I always wanted to do something that can get me out of the 9 to 5. And it was by accident that I found real estate. My wife and I would go to our CPA every year. We were both W-2 earners, and we'd ask this guy, "Hey man, how do we reduce our taxes?" And without even looking up at us, he just grumbled, if you make it, you pay it. And I'm like, get the hell out of here, man. There's got to be a better way. So I always heard real estate was a great way to offset taxes. I didn't understand how depreciation works or any of the write-offs really work. So I figured, okay, let's go out, let's go buy some real estate and see what we can do to reduce our taxes. So the first piece of property that I bought was a mixed-use building in a college town. It had apartments above a grocery store, which was essentially a liquor store for college kids, right? Just beer trucks in and out of there.
Sure.
And I got this place rehab, rented out, and every holiday weekend, every big weekend, I'd get calls from tenants, toilets clogged, sinks clogged, this is leaking. So I'd have to go down there because I didn't want to pay somebody else to do the work that I could do. And one day, it was a Saturday morning, I was out on site. A tenant had a clogged toilet. So here I am in the bathroom, unclogging a toilet. I could look out the window and see an HVAC company on the rooftop of the store, and they're replacing HVAC units, rooftop units. And I'm thinking, what? Like, I didn't call them. What's going on? So I go downstairs and I talk to the store owner and I said, "Hey, what's going on, man? I see all these guys running around on the roof." He says, "Ash, our HVAC went out." Or sorry, he says, "Our AC went out. So we're replacing the entire HVAC system." And I'm
Mm-hmm.
like, okay, am I gonna have to pay for any of this? And he's like, "No, man, it's in our lease. It's our responsibility." I'm
Mm-hmm.
like, "Yes, let's go." As I'm walking quickly out the door, he stops me and he's like, "Ash, do you mind if we remodel the bathroom down here?" And I'm like waiting for the cameras to come out of the woodwork. Is this real life? And I'm like, "No,
Mm-hmm.
man, have at it." I get home and I read this lease again. Sure enough, he's responsible for everything, including the parking lot, exterior lighting, and everything within his four walls, all the mechanicals. I literally dropped what I was doing at the time, became a full-time commercial real estate investor. I've since had a fair amount of residential as well, but every time I get into residential, I kick myself and I think, why doesn't everybody do commercial? So we manage our entire $50 million portfolio with two people, three people total, myself and two others, right? So we
Mm-hmm.
don't have property managers, we don't have leasing managers. We do it all in-house in a home office. So
Oh.
managing commercial is a
Mm-hmm.
million times easier. The competition is much less, and the returns are significantly higher.
Mm-hmm. Mm-hmm. Yeah, I mean, I understand that. Now, is that a triple net lease you had with that commercial tenant?
No, I would consider that a gross lease. He
Mm-hmm.
was just responsible for some maintenance items,
Mm-hmm.
but I pay the taxes, I pay the insurance. And
Got it.
what I want to stress here is there's an evolution that we have to break with real estate investing. Everybody
Mhm.
buys the house down the street so they can
Mm.
keep an eye on it. It's a neighborhood they like.
Yeah.
And then they might buy another house. They might buy a duplex. Then they'll buy a quad. If you're successful, you'll move up to a 10 unit, a 16, a 20 unit, and then you
Sure.
become a multifamily investor. That
Yeah.
cycle's got to be broken. It's vicious,
Mm.
right? It's the
Mhm.
returns are so low.
Mhm.
You're competing with a huge field out there. The
Mhm.
barriers to entry are very low.
Mhm.
I've asked people over the years, man, why don't you invest in strip malls? Why don't you invest in office? And the response I always get, oh, commercial's too hard. Well, no, it's not. Commercial's too expensive. I can find you a commercial property for the same price as a single family house in your neighborhood.
Sure. Yeah,
Like
maybe
it's
like a
just
single tenant.
mindset is all that's keeping people from doing it.
Yeah, absolutely. Or I've heard the excuses, oh, insurance costs more or the debt costs more. But it's all relative, just a number on a screen. And generally you can put down what are you doing these days on the debt side? Maybe 30% down for a commercial
20
building?
to 25.
Oh, okay. All right. So pretty similar to I mean, quite frankly, I mean, if you get agency debt, on a apartment as we do, when you start to get into the larger apartment buildings, it's 30% down for agency, right? Fannie Mae, Freddie Mac. So you're saying with commercial, you could actually get up to 80% LTV with 20% down. Is that correct?
Correct. And that often comes after building a track record and having lender relationships and
hmm
liquidity. If you're starting out, you might be at 25, 30%.
hmm And how are you usually financing these opportunities? Local banks, regional banks, or is there a more of a
100% local banks. Our
hmm
deals are pretty heavy value add. There's a
mm,
lot of hair on the deals typically.
right.
So any large bank isn't going to touch our deals. We don't have institutional capital wanting value add deals. So it's always a local lender as close to the property as possible.
hmm hmm Okay, so walk me through a deal if you can, as far as like how you source these opportunities as generally brokers or wholesalers, or do you do, direct mail marketing and then just underwriting them as well, looking, for triple net leases or single net or whatnot, and then what type of, assets you tend to focus on with your business?
All right. So there's a lot to uncover in that question. How do
Yeah.
we find the deals?
Mhm.
You would think broker relationships, because in the multifamily world, broker relationships, track record are key. In
Yeah.
our world, they mean very little. If a
hmm
commercial broker has a deal, they know how to price it to the market. So
hmm
we look for mismarketed, mispriced, or mismanaged deals. I'll give you an example of each one. So mismarketed, my two favorite commercial brokers, they only list deals on their own mom and pop website. They don't put it on LoopNet. They don't put it on
hmm
Crexy. They don't put it anywhere else besides, their little website that some kid made in a basement. So we
hmm
scour that site all the time.
hmm
And whenever they put deals on there, it's usually a home run.
hmm
So that's one example of mismarketed, mispriced. Now, there's good brokers and there's lazy brokers. We're
Yeah.
selling a $7 million strip mall right now. Our broker that we listed it with read every one of the dozen leases that we had. Some of
Mhm.
them are 70 pages long. He
Wow.
literally, like, not just combed through it, not just chat GPT'd it. He read every word in every one of those leases. This
hmm
way, he knows how to exactly price the deal. Now,
hmm
there's a lot of brokers, I would say the majority of them, they won't do that. They'll rely, Ash, give me the numbers and I'll find you a price.
hmm
The numbers don't always tell the whole story. Who's responsible for HVAC repairs, replacements, plumbing problems? All
hmm
of that impacts your price.
hmm
So, brokers that misprice properties. Another good example is one of our mastermind students found an office building that said it was 8,000 square feet and it was $400 a square foot. Makes no sense. He dove into it a little bit more. They didn't add the second story. So it's actually 16,000 square feet, right? So
hmm
whenever somebody looks at this listing, they're going to think, "Oh my God, this guy's nuts. It's priced too high."
Yeah.
Dive into it a little bit, right?
Mhm.
Find the mismarketed, mispriced deals.
At People's Capital Group, we help you invest in real estate. Build your wealth by owning professionally managed apartment buildings in the northern New Jersey market. We want to show you how owning real estate is attainable, even for the busy professionals that don't have the time or experience investing in real estate. Now, we only work with select people who are serious about building wealth. So find out if you qualify at peoplescapitalgroup.com.
Mhm. Mismanaged is fairly easy. It's a property that's got maybe a high vacancy when
Yeah.
all of the surrounding properties are fully leased,
Hmm.
right? It's tenants who haven't had rents raised in decades. That's
Hmm.
mismanaged. So
Yeah.
we look for those three things. In
Hmm.
terms of triple net gross leases, I don't care. Asset class, I don't care. As long as it's non-residential. So even geographic location, we're agnostic. We've got holdings all over the Midwest and Southeast, whether it's office, industrial, medical, bars, restaurants, retail, flex, ground up development. If we can make a killing on it, we don't care what it is or where it is.
Interesting. Now, that's got to be difficult though, because when you're going into a new market and a new asset class, there's a lot to learn. There's a lot of connections to be made, and a lot of information to fully grasp and understand. Do you have trouble, developing a good dream team, on boots on the ground in these markets when you're buying these assets?
No. The biggest advantage you can have in terms of property management, because again, we manage everything in-house, is at each of your properties, find a super user. Find the one person who's really passionate about their business, their building that they're in, and their community. And they will be your eyes and ears. They will do showings for you. If it's an office building, they'll unlock doors, they'll present the building probably better than anybody else because they actually have their business there. If there's contractors that need to get in, they'll facilitate that. We can also hire local residential realtors to help us out a lot. I didn't say
Mhm.
commercial, I said residential, right? To help us out
Mm,
with commercial properties. A lot of them are hungry to learn and break
mm.
into the commercial space. So, no, just be resourceful. But we don't ever think twice about buying in remote areas, even thousands of miles away.
Interesting. So instead of hiring a commercial leasing agent who's going to charge you a reasonably high commission and then want a commission every time the lease renews, you might hire a residential realtor who's hungry to break into the business and charge you a lesser fee.
For lease ups, we do a lot of that ourselves,
Hmm.
right? If it's a very unique space, like 40,000 square feet of big box vacancy, we
Hmm.
would employ a broker. That's
Hmm.
where their relationships with all the big box retailers comes in.
Yeah.
We'll still give it a shot, and we still have our group working on lease ups as well,
Yeah.
alongside with a broker.
Yeah.
Aaron, you
Yeah.
also mentioned triple net, or you know, there's this mystical thing about triple net properties, and people think it's just mailbox money. But
Right.
I'll demythify some of that. One, not all triple nets are created equal, right?
Okay.
So you have to look for the words absolute triple net, no landlord responsibility. Those are
Wow.
typically your McDonald's, your, national fast food chains that are the top 10%. But a
Hmm.
lot of triple net leases, you'll notice that the the taxes, the insurance, everything gets paid by the landlord. They can
Hmm.
charge the tenant back, but it
Right.
gets even more granular. Sometimes there's HVAC repairs are the tenant's responsibility. Replacements
Hmm.
are the landlord's responsibility.
Mm.
Or break it down even further, the tenant will pay for the replacement, but they amortize it over time. So
Hmm.
if they have 3 years left on their lease and the new roof or new HVAC system goes in, you're amortizing that over 5 or 10 years. You're only getting 3 years of payments from the tenant.
Right, right. Okay. So you might end up paying the majority of that HVAC replacement cost. Yeah.
And that's what makes commercial difficult, right? The devil's in the details of all the leases. That's why
Yeah.
that broker read every one of our leases because every
Mhm.
one of them was written by a different attorney in a different year, and everyone is completely unique.
And that's because you're buying kind of a mismanaged property that just had a bunch of different types of leases. And sometimes the tenant might have their own attorney who drafts the leases. Well, I'd imagine generally the landlord is drafting the lease, right?
The landlord will draft the lease in most cases. With national tenants, they have their own lease. They're not
Uh,
signing yours, you're signing theirs.
got it.
But then there's red lines that go into it, right? There's back and forth.
Hmm.
So every lease gets changed no matter who the tenant is.
Right, right. Okay. Do you find it easy to work with national tenants and national brands, or is it kind of more difficult in some senses?
It is difficult because they have a lot of leverage,
Hmm.
right? And most of them know that,
Hmm.
but you do whatever it takes to land them.
Hmm.
I'll give you a good example. We had 31,000 square feet, and it was a big box vacancy. We got O'Reilly's Auto. They came on for a 15-year lease, no tenant improvement money, meaning they just took the space as is. They're putting millions of dollars in renovations. And then all of a sudden they're like, hey, we just found out you have 6,000 square foot of vacancy next to us. We want that too, but we don't want to pay for it. And we're like, and at the end of the day, we would have done it, right? Because getting O'Reilly, that one signature yielded us $2 million in profit. Just signing that lease. The day we signed that lease with them, $2 million in profit. So, luckily, our team is awesome. And they negotiated, I think, $6 a square foot
Hmm.
for that additional 6,000 square feet,
Hmm.
which is a huge win. Because
Hmm.
and they probably knew this, but if they said we're going to walk from the deal, and they kind of did, we
Hmm.
would have done it. We would have said, okay, take it. We need this
Yeah,
deal.
yeah,
Because no
yeah.
matter what, they're adding millions of dollars in value.
Hmm.
Whenever we sell this center, we're selling it now, but the new buyers are going to see a 15-year, very high credit tenant signed for 40% of the square footage of the strip mall. What a safe investment, right?
Yeah. So you're saying the idea there, the strength of the lease will essentially lower your cap rate and increase your property sale price. Is that what you're indicating?
In addition to attracting coastal buyers.
Hmm.
So if we had all mom and pop tenants,
Hmm.
the buyer for a property like that is likely going to be somebody local.
Yeah.
If we have all triple net national tenants, somebody
Hmm.
from Alaska or overseas can buy it because
Hmm.
they're very easy to manage.
I got it. Okay. And also the other storefronts will probably lease up more quickly for a higher square foot if you have a more popular store there, like a Walgreens or something bringing in a lot of traffic, then you're going to ideally get a higher price per square foot for the other units. Would that be safe to say?
You nailed it, right? So this particular strip center
Mhm.
has two anchor tenants. They have O'Reilly's and Dollar Tree.
Sure.
And if you think about all the traffic they bring in, who
Hmm.
wouldn't want to be a neighbor to them?
Hmm. Hmm. Of course. Yeah. Yeah. All right, that's interesting. That's interesting. Yeah. So, and then also with, so the other objections you have the cost of insurance and the interest rate on commercial properties there. What are you seeing right now with interest rates on loans for new acquisitions of commercial real estate?
Aaron, we're underwriting at 7, and we're usually landing somewhere within a quarter point of that.
Okay. Okay.
So we're
So
higher than multifamily.
yeah. Yeah. And why is that? Because it seems like a very safe long-term investment. Why are the interest rates so high on commercial real estate?
Two reasons. One, there's no agency debt available on
Mhm.
value add deals.
Okay.
So it's whatever lender does the deal, they
Hmm.
hold it on their books the entire time. And there's
Mm.
no secondary market where they can trade these loans. So if you think about when you have a residential mortgage, every 6 months or so, you get a letter saying, hey, now Capital One is going to manage your loan, and now
Yeah.
Chase Bank is doing it.
Right.
They sell these things as commodities.
Right.
Value add commercial deals, there's no secondary market to sell them or trade them. So there's no intrinsic value other than what the original lender puts on it.
At People's Capital Group, we help you invest in real estate. Build your wealth by owning professionally managed apartment buildings in the northern New Jersey market. We want to show you how owning real estate is attainable, even for the busy professionals that don't have the time or experience investing in real estate. Now, we only work with select people who are serious about building wealth. So find out if you qualify at peoplescapitalgroup.com. Got it. Okay. And as far as insurance goes, I mean, insurance has skyrocketed on us. We used to underwrite deals at $800 a door. Now we're underwriting them at $1,400 a door for insurance, in just about a 2 year period or so. That's how much it's gone up by. What are you seeing? I guess you do a per square foot in commercial. Is that right?
Now, every asset class is different.
Mhm.
It comes down to replacement cost, age of the property, age of the roof, current condition. Our costs are very reasonable. We might have gotten a 5 or 10% increase over the last year. Sorry, for the strip mall that we bought for 5, selling for 7.4, it's 100,000 square feet. We pay around $10,000 a year in insurance,
Okay.
which is
Sounds
nothing.
yeah, that's very cheap. Yeah, because I'm thinking 100,000 square feet would probably be like 70 units in residential real estate, something like that. And that would be far more than that. It would be like $80,000 to $90,000 a year in insurance. So far more than
It's
commercial.
yeah, it's not a big line item for us.
Mhm. Yeah. Wow. So that's actually extremely cheap compared to residential. That's interesting. And then let's just pivot briefly to like warehouses and other types of commercial real estate that you invest in. Are there other asset classes beyond strip malls that you also own?
Yes, everything from medical, industrial,
Right.
warehouse, bars, restaurants, office. Again, we're asset agnostic, right? So
Mhm.
we'll buy anything, anywhere if it makes a lot of money.
And do you trouble managing different types of assets like over the last 10 years? There's so much to learn. There's so many different service providers. Is that one of your challenges?
I'm thinking back to the beginning. I've been doing this for 15 years.
Mhm.
In the beginning, I'm sure there was a bit of a learning curve, but once you understand one asset, you understand the majority of the next one and the next one. The underlying principles stay the same. It's just some of the dynamics change. What
Mhm.
office users want is going to be different than what a retail user wants versus a medical versus an
Mhm.
industrial, right? You just have to understand what your tenants' needs are.
Interesting. Okay. Okay, that's great. All right, Ash. So it sounds like you have a wealth of experience and success in the space, and since we spoke, like I said, you planted that seed in my head, like, maybe we should start looking more at strip malls and different commercial. I mean, I see office deals, they're just giving them away right now, 40% vacant, huge buildings, big parking lots, nice locations. They're just like super cheap. And I do think office is going to come back. I love actually the idea of strip malls. I mean, I see them in Jersey here. You were saying one of the lowest vacancies for strip malls is one of the states with the lowest vacancy is Jersey. And I could see that. It's a really densely populated state with great traffic. So you definitely got my wheels turning and from our past conversations here, and I we do own some mixed use real estate. In fact, one of the first buildings I bought was a storefront and 4 apartments above it. I own it to today. It's probably 4x in value and still cash flows after 2 refinances. So yeah, I do like the space. It's definitely very attractive and industrial too. I know industrial's done very well in the last 5 or 6 years. I've heard some great stories from other investors I know in that space. Medical, I mean, the medical industry is just going to continue to grow as the demographic ages. So I think medical is a great place to plant your flag. Um, and office, if you have the stomach for it, and the cash reserves, you can do well by scooping up for a great price in this time, and then leasing up the building maybe at a lower price per square foot now, but growing that over time, especially if you make the building have the amenities that a lot of, there's a lot of like outdated office space that just kind of doesn't have the amenities and the whistles and the bells that current office tenants are seeking. So if you can kind of reposition that into a nicer office building, there can be a lot of value there as well. So got the wheels turned on my end, my friend. I'm very curious to learn more about how you make sense of these different asset classes. How can people connect with you and learn more about what you have going on these days?
Um, I'll tell you everything, but how much time do you have?
Well, we're usually do about a 30-minute podcast here, and I think we have about 3 or 4 minutes left. So what do you have to say?
I want to give your audience a little bit of actionable advice, right?
Sure.
So, what you're doing, mixed use buildings, for anybody that's investing in residential, find a mixed use building. And the way you underwrite those is the apartments should pay for all of the expenses. Whatever retail you have on the first floor should be pure profit. So you have a
Mhm.
safety net, right? And it gives you an entrance into non-residential commercial. Now, for office, it's very simple to underwrite office today. Look for at least 15% cash on cash and at least 20 to 30% vacancy, and look for recent leases signed. It's that easy,
Mhm.
right? Those three things, and you can start underwriting office. So if somebody signed a lease in the last year for an office, that's great. There's demand. If all the leases were signed pre-COVID, well, they might just be running the clock down, right?
Mhm.
So two very simple, actionable items for your audience that I really want them to pursue. And if they have any questions, email me. It's Osh at investbeyondmultifamily.com. I'll give
Mhm.
you my cell phone number. It's 513-520-1233. And that's my number that no one else has access to. So if you text me first, it's just me.
That's awesome, man. I love how transparent you are. That's great. That's great. And then you also have like a mastermind group that you operate. Is that right?
I do for 4 years. I started this again not by choice. I had a bunch of apartment people that wanted to learn commercial. I gave them hours and hours of my time, and I was a one-man shop at the time, so I had no desire to be a coach or a mastermind guru. They kept pushing, and this thing just evolved. We've done 4 or 5 years of this. We've got about 100 students. We've never had a single student lose money on a commercial deal ever.
Mhm.
So we do meetups a few times a year, but every Tuesday it's a Zoom call.
Okay, that's great. How could people learn more about your mastermind group?
Just go to investbeyondmultifamily.com.
Okay, investbeyondmultifamily.com. Very cool. Yeah, I'm going to check that out myself, my friend. I mean, listen, we've been very successful in the multifamily space. I've done about 300 transactions here in New Jersey. We've learned the market well. We have the in-house property management company, the infrastructure in place. It wouldn't be that hard to scoop up a couple strip malls and add them to the portfolio, or an office building or warehouse space. So I do come across deals there. I usually just say, nah, we're really just focused and built for multifamily. But I think I'm going to open up my mindset a little bit more. The more we talk, the more you inspire me here, and it's good to have an open mindset. At the end of the day, like you said, we look for really great deals, and if he's out there to make incredible returns for our investors, we want to move on them and want to take advantage of them. So but that's amazing. So one more time, what's that website?
Investbeyondmultifamily.com.
Excellent, excellent. All right, Ash, I really appreciate you coming on the show, my friend. You are a wealth of information and inspiring to our listeners. And to our listeners out there, if you're getting value out of the Passive Cash Flow podcast, share this with a friend, share it with a colleague, share it with someone that you think could grow their passive income, their passive wealth, whether they're invested in real estate or not. We cover all different types of topics. We have tax specialists, insurance, RIAs, real estate investors, and we cover all different types of topics here on the Passive Cash Flow podcast. We have over 170 episodes, come out with a new one every single month. And be sure to subscribe. We are on YouTube and all the major podcast platforms there. So be sure to subscribe on those platforms if you haven't yet. And please share this with a friend if you feel like you're getting value out of it. Of course, I'm Aaron Fragnito, co-founder of People's Capital Group. We help people build and preserve their wealth in New Jersey apartment buildings. But hey, after listening to this episode, I might have to change my marketing message here. We may have to get all of our might have to change this back here. It says helping people invest in real estate. Okay, good. We won't have to get a new plaque in the office here because that'd be expensive. So if we get into beyond multifamily, we can keep a lot of our plaques in the office and our marketing materials. So that's a good way to kind of transition there. But thank you so much, my friend, for coming on the show. I appreciate your time.
Thank you as well.